Good morning. Today is uh, Tuesday, August 9th. Thank you for joining us. I had an addendum to the Zoom notes here, and of course, the date gets pushed to the top on the first page and not the second page. We're going to jump in right now and talk a little bit about what's been going on with companies, and then we're going to talk about geopolitics, because there's some updates that we want to get to on Taiwan and just if that impacts markets. And then we'll give you a quick preview of the CPI report, which is really going to dominate tomorrow before the Disney earnings come out tomorrow evening. So just jumping into the guidance numbers, this isn't coming in the context of sell-side analysts. What's a sell-side analyst? A sell-side analyst is someone who works for a big bank and gets paid to do research on these companies, and they have buy ratings, they have the sell ratings, they have the neutral ratings. Typically, a lot of sell-side analysts will put buy ratings on stocks because there is an incentive to do so. Stocks go up over time. They're less likely to be wrong. They're hearing the information from management, and importantly, their bank relies on the investment banking fees from those companies. And if you have a sell rating, you're not likely to get the investment banking fees when they do a merger and acquisition or they become public, et cetera. So this is why there's an upward bias to sell-side analysts. But what's interesting about this moment is that sell-side analysts are actually about as bullish as they've been, really as bullish as they were in 2000 and 2007. They're especially bullish on the US. They're more bullish on the US than in Europe and Japan. And they've also been becoming more bullish on consumer discretionary and material stocks over the past 18 months. And kind of tech stocks, utility and communication services kind of been a little bit more slower to move. So that's where sell-side analysts are. But you're getting all this in the context of earnings estimates that are starting to come down rather significantly. Even though companies already reported earnings just a few weeks ago, they're starting to provide negative guidance revisions for the upcoming quarter. This is the same thing that we saw with Target and Walmart last time around. Nvidia yesterday came out, it was down 6.3%. I'm surprised it wasn't down more, frankly. They guided for revenue in the upcoming quarter to be 6.7 billion. They had previously guided to about 8 billion or slightly higher than that. Their earnings number, because they're also not only getting hit on revenue, but they're also getting hit on margin, their earnings number is going to be about 50 cents. Their prior guide was $1.25. And importantly, they're also including $1.3 billion of charges, primarily for inventory and related reserves, quote, based on revised expectations of future demand. I kind of interpret this to me, Tom, and I'm interested to hear your take on this, as liquidation mode. The question is, does this ultimately filter through to prices? Because ultimately, if the end result of this is lower inflation, I think that's a win. Obviously, it's bad for Nvidia in the near term, but I think overall, on a macroeconomic perspective, I think it's a positive.
Yeah, I mean, we've talked, for 2.5 years now about the supply chain issues and the chip shortage, but I think the indicator here is that they don't have a chip shortage, they have a chip surplus. They've, just like Target ordered too much patio furniture and nobody bought it. The chips was the rallying cry for the last 2 years. Now Nvidia's like, hey man, we got all these chips, and everybody's like, yeah, no thanks. We don't need them. We don't have the demand anymore. And so they're on pace to make 40% of the profits that they were expecting for this year, which is a huge cut. Saying from like, hey, we're going to make $1 to making 40 cents is a massive, massive cut. So I think net for inflation, that's probably, this is probably more in line with what we thought was going to happen towards the front end of the year, which was that inflation was going to start to come down naturally because, we're going to see supply chain issues come down and unwind. And I think this is an indicator that that's, partially the case, right? The chip shortage has now become a chip surplus, which means we have plenty of supply. There is no supply constraint. I think that leads us kind of naturally into Micron doing the same thing this morning.
Yeah, Micron's doing that as well this morning. Nvidia said that gaming was the biggest culprit. Micron just said broad-based declines in the macro. They're actually reducing their capital expenditures for next year, quote, meaningfully. They said that their revenue is going to come in at the low end or even below their prior forecast. And they said that even looking ahead to the following quarter, which would be the December quarter, they said they see significant sequential declines in revenue and margins, and revenue down meaningfully. And I don't think Wall Street is even close to that. I think that estimates will have to come down probably 15% on the top line, similar to what we saw with Nvidia, and maybe even more pain on the margin side because Micron's a little bit more of a commodity. Signet, the jeweler. So it's happening in chips, it's happening in jewelry. Signet actually, they had two announcements today. The first, I think, is actually a good deal. They just bought Blue Nile for $360 million, all cash. Blue Nile delivered more than $500 million of revenue in 2021. It's a very good valuation. My concern is it's almost too good. This company is, I mean, I've known a lot of people who got engagement rings, et cetera, from Blue Nile. It's a large company. 360 seems like a very low price. Signet seems like it's making a steal. I wonder if they have a lot of off-balance sheet liabilities, which Signet is also assuming.
Yeah, I mean, there is a possibility that if it is off balance sheet and they've got that inventory lever, that scale potentially could bring that down, which is maybe perhaps why they were so ready to sell to Signet. Because, you know, one of the things we like about Signet, and we really only own the debt, we don't own any of the equity, is the fact that one, they're very, very light on debt. And I believe that they're potentially misrated in terms of what the ratings agencies are listing as their rating. But the fact that they have a huge market share in what is otherwise a very splintered, operation. So they've got like roughly 9% market share, and, everybody knows somebody who knows a jeweler that's one guy in a shop. So that doesn't sound like a big market share, but that for the industry is very, very large. And this consolidation helps them continue to breed their online presence, which has been a big move for them over the last couple of years. So now, Blue Nile, which I feel like is probably the first one that comes to mind when people say, hey, I'm going to buy an engagement ring online. And then, Jared and Zales are probably the other two first to come to mind. So putting those together, both the biggest in terms of brick and mortar, the biggest in terms of online, and using that to kind of continue to push into a larger market share position. And at a certain point, even if you only have 10%, but the rest of the 91% or 90% is split among individual operators, you can have real scale real quickly and be in a dominant position. So, obviously them scaling down their revenue numbers is not ideal, but I think this is a good deal. And I'm definitely going to spend some time digging into it, make sure it doesn't affect the balance sheet too much. And we'll feel comfortable still holding on to those bonds. But they performed, I mean, they may be among the best performing bonds in the portfolio, despite their lower rating. We've seen high yield just get absolutely punished, and so those bonds are down 1.5%, 2% depending on where you purchased them this year. That's pretty darn good in this environment.
And this wasn't on the agenda, but I think those bonds coming off in 2024.
Correct. Yep.
And so that's exactly where we are on the corporate side. We're not trying to reach out and take a lot of and not hold this paper for an extended period of time. We want something that's paying off and paying off soon. And we have line of sight to when that happens, especially on the corporate side and even increasingly on the muni side. We're looking, the sweet spot is kind of that 28 to 30 maturity in terms of 2028 to 2030. And that's kind of what we're seeing throughout the fixed income. But Signet, as Tom mentioned, did reduce its guidance. It's down about 6.5%. And they say they saw sales soften in July as the customers have been increasingly impacted by rapid inflation. And so they're revising guidance to align with these trends. They said that while their initial guidance for the fiscal year anticipated the impact of stimulus in the base period and the level of inflation that they were seeing, they have seen a further deterioration in consumer spending, including at higher price points in July, which is interesting to me because I think a lot of what we've been talking about has been a concern with the consumer at the lower end. But this is talking about a concern with the consumer at the higher end. And this is something that Restoration Hardware has talked about as well.
Yeah, I mean, I would argue that the engagement ring is the most expensive thing you can buy that has very little utility other than showing it off. So I think that's an easy cut for people.
Financing costs probably hurt that as
yeah,
well.
absolutely.
Novavax also taking down its guidance. They have a COVID vaccine. They cut their revenue guidance by half. Yes, half. Their stock is down 31% this morning, basically just saying that they saw lower uptake in the vaccine. And they said in the case of the US, we were late to market. And I would say, yeah,
They were the last one in. And at that point, they'd already been functionally pushed out.
There are some anecdotal reports on these forums that I follow that Microsoft is laying people off. There's about 300 people laid off. That's relatively small proportion of Microsoft, but I think it's worth noting that these tech companies are acting in line with what they said that they were going to do, which is rejigger things, consolidate, and marshal resources into the most important areas and kind of push away those that aren't revenue generating. So that's where we're seeing in the company land. And so this kind of undergirds our cautious view of economic development over the next 6 to 12 months. Things like this happen at the start, not at the end. So that's what we're seeing. Geopolitics, talking a little bit about that. Russia has halted crude oil flows via pipeline to Central Europe. They're saying that it's not their fault. It's the fact that they really wanted to pay this transit fee on this pipeline to take oil to Hungary, Slovakia, and Czech Republic. But the sanctions meant that when Russia paid the transit fee to put oil through the pipeline, it was just returned. And Russia said, well, we want to make sure that we're paying the right toll and get that oil. And right now, there's no real response from the Ukrainians. I think there's just more Russia games.
Yeah.
Wanted to get back in the news.
100%.
And then in Taiwan, the Taiwan Foreign Minister Joseph Wu said at a briefing in Taipei yesterday that China's recent military drills are aimed at changing the status quo in the strait, and that the activity fuels concern that Beijing may proceed with an actual invasion. How much of this do you think is bluster, and how much do you think is real?
I think it's mostly bluster. I don't think that China has any interest in actually invading Taiwan. They already functionally control Taiwan to the level I think that they feel comfortable with. I mean, at this point, what are they going to do? Go in and just march on Taiwan? I mean, does Taiwan even have a military? I mean, are they going to defend themselves, door to door with actual civilians? I just think that it doesn't benefit anyone involved for that to happen. I mean, Taiwan is their crown jewel in terms of, commerce. Why not just let it be that and, exert dominance, show that, this is your toy, you have control over it. We're going to fire missiles all around the island, but it doesn't make any sense to me to start blowing it up. But
I think it's going to be exactly the same thing that we saw with Hong Kong. Remember when when China had all those videos of all that military force, those hype videos, and then they subtly took Hong Kong down from the inside, basically reduced their voting power and put in puppet governments. And I think that you might end up seeing that in Taiwan.
Yeah, I think it's a far more likely outcome.
That's just their MO. Finally, we're going to shift. We're going to finish with inflation and what we can expect tomorrow. Right now, it seems like hiring actually continues, but that's kind of the one bright spot in the economy right now. Everything else is down. If you look at the NFIB Small Business Optimism survey that came out this morning, capital spending is going down. Inventory investment plans are going down. Real sales are going way down. The environment for expanding is negative. Interest rates are rising. It's just not an optimistic picture. Hiring's still up for now. How does inflation fit into all this? And where do you expect inflation to go? At the end of the day, inflation is the critical piece. We were talking to a client yesterday and said that, hey, we have a cautious view over the next 6 to 12 months for reasons primarily related to negative real incomes. The one thing that could change that may be inflation coming down significantly faster than expected. What do you expect tomorrow, Tom? And do you think that changes the path of inflation going forward?
I think the issue we have now is that inflation was siloed in a couple main areas, and that brought the average up, right? Used cars, travel, oil, all those things were exceptionally elevated, up 20,
transitory.
Yeah. They're up 30, 40% year over year. And so the average was very high, but there are some things that really hadn't moved. I mean, medical care hasn't really moved all that much. But I think the difference is all of those things have fed into everything else now. So if oil prices go up, that makes everything more else cost more. And so even now that oil prices are coming down, all of the new goods that are being produced have been produced with a much higher cost of input. And what does that mean? We've got to raise prices. And we've already seen it from a number of companies saying, hey, we're pushing through 10, 15% price hikes across the board on all things. So now that's coming through. And so instead of it being a few very, very high peaks bringing the average up, I think it's going to be everything is going to be moving up while those things are moving down. I think we really functionally, as a percentage, don't get a lot of change. I mean, I wouldn't be surprised if we came back in at 9% again. And the reason is because some of those things have come down significantly, but almost everything has gone back up. But I think that if you go in the grocery store, you probably agree that there isn't a single item that is cheaper now than it was 2 months ago. In fact, more things are more expensive than they were.
I really like the kettle salt and pepper chips, but I don't want to spend more than $2.69, $2.79 on a bag of chips, and you can't get a bag of chips for less than $4. It's just incredible how much prices have gone up. Goldman, for its part, expects the report to come down a little bit on the headline because it expects the energy component to drop 3.2%. But they say we expect core inflation to actually move higher from 5.9% to 6.1%. And the Fed's not going to like that. The Fed's not going to like that at all. And if we come in especially hot, I was listening on the radio this morning, and Jim Cramer, take him for what you will, but he says that with no meeting in August from the Federal Reserve, he would not be surprised that if inflation came in especially hot, and I'm saying probably 9.4% on the headline, maybe 6.4%, 6.5% on the core, he wouldn't be surprised if the Fed just came out and hiked.
I mean, it's certainly possible. I mean, we've just from last week, we've seen the expectation for the rate hikes go from, 40% to 80% for a triple rate hike. And so, yeah, it wouldn't surprise me if they just said, let's just do it. Why do we have to wait a month? Why do we have to sit here and wait until the 21st of September to make a move when clearly things aren't moving the way we want to? So, I mean, I still think it's not outside the realm of possibilities that we get 9 more hikes this year. If you look at futures right now, it's saying 5. I mean, if they do a triple rate hike, was it Mary Daly came out and said we should continue to do triple rate hikes until inflation comes down? Well, odds are it's not coming down anytime soon, and they're going to have to be very aggressive to get there. I mean, the federal funds rate's only at 2.5%. Historically speaking, they haven't been able to bring down inflation without exceeding inflation with the federal funds rate, which means we've got another 7% to go, which is what, 70 hikes? How many hikes is that? I can't do math in my head, but quarters.
It's a lot.
Yeah, it's many, many, many hikes, which, we haven't even scratched the surface at this rate. So.
All right. Well, thanks, Tom. Thanks, everybody, for joining us. We will be here tomorrow morning. We'll go over that full report with you tomorrow morning and preview Disney earnings as well. Have a great day.